you can't see everything from just a PayNet report and a credit bureau report. So if there's anything within the deal that you're feeling uncomfortable about, or just knowing where the industry is at, getting that additional information can go a long ways to make sure that you're protecting yourself.
Welcome back to ACS Portfolio Perspective. I'm your host, Andrew Pace, Chief Client Experience Officer at Asset Compliance Solutions, joined today by Justin Pavek, Chief Credit Officer at Wallwork Financial Corporation. Justin brings over 13 years of commercial finance experience to this fourth-generation family business based in Fargo, North Dakota. After serving 6 years in the Army, including a tour overseas, Justin earned his bachelor's in economics from North Dakota State University and later his master's in applied economics from the University of North Dakota. His career journey took him from the Farm Credit Administration through U.S. Bank and CoBank before joining Wallwork Financial in 2019, where he now leads credit collections and legal functions while serving as chair of the credit committee. Under Justin's leadership, Wallwork Financial has navigated the challenging transportation market while maintaining industry-leading delinquency rates well below industry benchmarks. Justin, welcome to the show.
Thanks, Andrew. Appreciate to hop on this with you and have a conversation.
It's great to have you, Justin. I've really been looking forward to this conversation. You've had such a unique path from the Army to economics to leading credit strategy. We've seen in years. There's a lot to unpack, and I know our listeners will get a ton of value from your perspective. Let's dive into today's conversation, starting with the current state of the transportation market and how it's influencing credit decisions across the industry. It's seen such a prolonged decline. How has that shaped your approach to some of your credit decisions?
Yeah, we try to stay consistent with our credit decisioning. I mean, obviously, with the state of the industry that we're in right now, we're primarily in the transportation space with equipment finance. We're going on 3.5 years now, approximately, of a downturn in the market. When you look back at what caused all of this, COVID was kind of the unique event that led us to where we are today. And even backing up to COVID timeframe, I mean, that was a unique time in equipment finance as well. Valuations were through the roof. People were paying insane amounts for used equipment because new equipment wasn't available. So back at that point, when we were looking at deals, every deal we look at, we have a valuation that we put on it, what we think the market value is, and we just stayed consistent, and we continued to do that through this downturn. We stick to our guns on the structuring. We don't go outside of, the taking a lot of additional risk when people are paying more for equipment when we know it's not worth that. And then getting into the credit environment today, it is creating more questions. A lot of people are struggling out there in the industry. So we are asking for more information when we're underwriting credit, whether it's bank statements, tax returns, internal financial statements, just to get a sense of how they are weathering the storm and if we feel like they're going to continue to kind of trudge ahead through this.
And you mentioned COVID. So how did the post-COVID correction catch some lenders off guard, and what allowed Wallwork to stay ahead of it?
Yeah, and the transportation industry is really unique, and it's not something prior to my time with Wallwork Financial I really had any experience in. So I picked up a lot and learned a lot really quickly. I started with the company in 2019, and at that point in time, we were starting to see signs within the transportation industry that the next recession was coming. And then all of a sudden, COVID happened in 2020. And that kind of just sparked everything. Everything went through the roof. Rates were really high. Freight rates were really high. And it just created this environment where so many people entered the market and so many finance institutions saw this as, well, things are going really well. We want to do a bunch of these deals. People were getting really competitive on price. When you look at the transportation space in general, there's not a whole lot of barriers to entry for somebody to buy a truck and start a business if have the finance companies willing to support that. And that's what was going on at the time. And it just kind of blew up the industry. But at the same time, I guess the way we looked at it, we realized this isn't going to be sustainable. Eventually, it's going to hit a point, inventory is going to get back on track, all this freight's not going to be on the market, and rates are going to start to subside. And people are overpaying for equipment, so they have really high debt payments at the time when rates are high. They can make them, but they weren't able to continue to do that once rates start to drop. So from a credit underwriting standpoint, I mean, we look at all that. We take that into consideration. We look at the strength of the credit, and we want to make sure we're making informed decisions to ensure the customers we put on the books are going to continue to be viable businesses, even in the environment that we're in today.
Yeah. So while your portfolio is performing, remained strong while others struggled, you attribute that to your strong credit underwriting, decisions. And is there anything else that it can attribute to that?
Yeah, absolutely. I mean, it comes down to the credit profile that we are looking for. We consider ourselves an AB credit lender, and I always say you could ask 20 different finance institutions what AB credit means, and you're going to get a different answer from everybody. But at the end of the day, it's the really high profile credit customers that we're looking for. And those are the kind of rates we offer too. I mean, we don't get into the high rate, the double digit rates. That's just not who we are. Mm-hmm. Granted, there's a market for that, but that's not something Wallwork Financial's ever been in. And with that comes the better, I guess, delinquency rates. We tend to fare a lot better than the rest of the industry just because of the credit profile that we're looking for.
And how would you strike the right balance between, seizing growth opportunities and managing that credit risk in this kind of market?
Yeah, just like everybody else, we want to grow our portfolio. We want to be a bigger company. We want to have more volume on the books, but just to do it slowly and consistently. We're not looking to go. I mean, there's deals like look at. We could be $1 billion company, but that's not the approach we want to take. We want to do it the right way, and just make sure we're putting stuff into our portfolio that we know is the right thing to do.
Gotcha. The long-term mindset seems to be a differentiator, especially in a volatile environment. Speaking of long-term thinking, let's shift gears and talk about the unique perspective that comes with being part of a multi-generational family-owned business. How has being a fourth-generation lender shaped your, decision-making and customer relationships?
Yeah, we have a lot of experience in the industry. I mean, on top of Wallwork Financial, we also have a truck dealership. So we have people within the industry that know it very well. So even if there's a question that we don't know the answer to, we have somebody within the company or resources that we have that we can get those answers. So when you look at, I guess, the fourth generation piece of it, we have an excellent ownership group. They've learned to trust us in what we do. They know they have the right people in the right seats. And it's really been beneficial for us to kind of manage and run this company to keep it sustainable. And then when it comes to the direct relationship, we're a family-oriented business. We want to make sure we're doing business with people that have the same values that we do. And the best way to do that is to have those direct relationships, get to know the customer, get to know their business, make sure we're helping them make informed strategic decisions on the equipment finance side, but also just general business. We're looking at financial statements. If we see things within them that we think there could be some improvements they can make, we'll have those discussions with them. So we're more than just an equipment lender. We're more also an advisor to the customers that we have.
Yeah, that's great. That's a great philosophy. And you stayed in the transportation market even when others pulled back. What drives that consistency?
Yeah, it's who we are. I mean, that's how the company started, was just supporting our dealership, and we've grown to a nationwide company. We have reps throughout the country. Transportation is what we do, and it's not something we're looking to get out of. It's just you have to know how to navigate it through the tough times.
Sure. And is there any areas of the country where you won't finance, or are you've got in all 50 states?
Not necessarily that we won't finance. We just don't see as many opportunities in certain regions. We don't have reps out on the East Coast, so we don't have as much volume in that area. Obviously, if you get into like the Hawaii or Alaska regions, that's a little different just because it's so far removed from us. Sure. But we do have business in those states too. So there's no limitations on where we'll do business. It's just different areas carry different risks, and we'll make sure we assess that when looking at each deal.
Sure. And can you share with our listeners, what does the in it for the long haul philosophy mean to your customers?
Yeah, kind of just what we were hitting on there. I mean,
Yeah.
we're in it in the good times and the bad times. We're not looking to pull back and get out of transportation. You see that a lot in the industry today, and I get it. I mean, banks are looking to have diversified portfolios. A lot of finance companies are. So you see that happening where they'll get into transportation when it's good and get out when it's bad. But for us, like you said, we're in it for the long haul.
And how do you guys, continue to maintain that relationship-based approach in an industry that's leaning towards more into automation?
It has created a lot of challenges. It's really just having our reps be out there pounding the pavement, getting in front of customers, having those conversations, setting up meetings, cold calling, just getting our face in front of everybody. Once they can actually see what Wallwork Financial has to offer and the value add that we can provide, I mean, at that point, it's a pretty good selling point. It's just to get in front of people is the biggest thing, and that's really the push that we have on our reps in the field.
Yeah, that personal long view approach certainly stands out, but it's paired with, real innovation too. Let's talk about how you're leveraging technology and data to enhance operations and credit performance. What led your implementation of Salesforce and Power BI, and how has that changed how you manage your deals?
Yeah, so Salesforce we implemented in fall of 2020. The prior system we had, I mean, it worked. It just wasn't, the deal flow process wasn't very smooth. It was more so just a place to store all the data. Through setting up the Salesforce platform we have, the initial intent was to use it for the deal flow process from start to finish. But now also we're integrating the CRM function that really is what Salesforce is meant to be. So our reps are finding a lot of value with that too, to enter prospects and leads and keep track of conversations that they have. And then with the Power BI piece, that's new. We're in the works of implementing a data set that we can analyze through Power BI. We're using a company called Tamarack. They're currently in the process of getting all of our data compiled. And then next stage will be to actually push the product out. But by doing that, we're going to be able to assess all the historical data that we have to be able to make better informed decisions in the future. Looking at delinquency rates and different credit risks that we were taking, what happened with those deals? Did we look at something wrong? Do we need to change our approach? Do we need to change our scorecard? All those different things.
Yeah, and you just mentioned, performance. Can you walk us through how you're currently using analytics to refine that underwriting and portfolio performance?
Yeah, right now it's a pretty manual process. So our front end system is Salesforce, and then we use Lease Complete on the back end to house all the deals that we have on the books. But yeah, it's pulling all the data manually out of that, basically into an Excel file, and then having different models that we have built to assess it. So by implementing this Power BI platform, it's really going to help make that more efficient for us.
Yeah, so it sounds like you're taking a really cautious approach to AI. What role do you see it playing in the credit and collections going forward?
Yeah, and we're already seeing in the market, there are some bigger financial institutions that have auto decisioning in place on the credit side. And that's something we are going to have as part of this product. I'm a little hesitant to just say, all right, the data's there, you have the model set up, we're going to use this. So our plan is to look at it side by side with the process that we have today and see what kind of output we get. And then from there, build off of it and tweak it however we need to hopefully get to a point where we are comfortable with that. But there's no intentions in the near future. But you can see that that's the direction that the industry is going. And then on the collection side, a lot of it will just be around portfolio management, being able to look at all the data that we have in one spot to kind of figure out the best strategy with maybe a current customer we're trying to work out of. How did we deal with situations like this in the past? What successes did we have? What kind of losses did we have? And a lot of that ties into, again, on the front end, on the credit side, is making sure that we're structuring deals appropriately, because transportation equipment in itself is extremely risky, just the way it's utilized. And usually if it gets to the point where we are recovering it, it's not in good condition anymore, and we end up taking pretty substantial losses on anything we take back.
Yeah. with a strong tech foundation and deep portfolio insight, you're well positioned to deliver a standout customer experience. Let's close by talking about your move toward more direct customer relationships. What inspired the shift for driven business to a more customer direct model?
Yeah, so credit, looking at the credit aspect of it, every deal carries different risks, and there's different pieces within the credit that carry their own weight of risk. And we found that deals that we have the direct relationship with the customer on, we have way more success on the collection side if it gets to that point. Obviously, when you book a deal, you don't expect it to get to that point. But we have had way more success with those customers working out of it, them cooperating with us if it does get to the point where they just need to turn in the equipment. We're on the flip side, broker deals, dealership source deals. Not saying those are bad. We just don't have that connection with the customer. And if our first call to them is on the collection side, we're basically building that relationship when things are already in a tough spot. So that's really been the push, what got us to the point where our main focus is on the customer direct side, is knowing that by having those relationships, it only strengthens the portfolio.
Gotcha. And what are some of the value added services you're offering that go beyond just the financing at Wallwork?
Yeah, so like I said, part of it's being an advisor to our customers, being able to have those conversations, having the knowledge in the industry, seeing what's going on. We also have an inventory manager on staff. He does all the valuations on the equipment that we look at financing. But with that too, he can get with customers, look at the equipment they have. Maybe they want to liquidate some equipment. He can give them a baseline on values that they should be able to get out of it, just to help them make more informed decisions too, when they're working through that, both on the buying and selling side.
Gotcha. And how is the ability to fund quickly, sometimes within 24 hours, set you apart in this space?
Yeah, the speed of the transaction is huge in this industry. It's a really big talking point when we're meeting with customers. It's how quickly can you get the deal done for me? So our ability to do that, if we have all the information we need, we can get a deal done in a couple hours if we have to. Not saying that happens all the time, because usually there's some information that we need to gather, but if we have everything we need, especially if it's an existing customer already on the books, we can move very quickly. We do offer a line of credit product with some customers, so we'll underwrite the credit and set basically a limit that we'll go up to with them based on the equipment they're buying. We'll structure it appropriately, obviously, but things like that, if they send us an invoice and a spec sheet, we can have that deal funded in 20 minutes if we had to.
Yeah. And how quickly after that are they, taking delivery of that truck?
It'd be immediate. Yeah. We get calls sometimes. It's like, I'm at the dealership, I'm ready to pick this up. Can we get this deal done? And we can do it
that quickly. That's fantastic. That's speed right there.
Yeah.
In today's digital world, how do you maintain the real person picks up the phone philosophy?
Yeah, and we pride ourselves a lot in our customer service too. We have real people answering the phones. It's people in the office. It's not outsourced anywhere. If a customer calls in and has a request for a payoff, or maybe they want to adjust their payment schedule somehow, whatever it may be, we have somebody they can talk to directly and work through that with.
And have you seen stronger performance or loyalty from these direct relationships?
100%. Yeah. And it's not like we're picking and choosing who we're willing to work with. It's just so much easier to work with somebody that's willing to communicate with you and have the tough conversations if you get to that point. We have a few deals right now that we're working out of, and it's been really, the big success on that is the customer portion of it. It's having those relationships and being able to talk with them directly.
Gotcha. Let's shift gears and talk about something that's affecting everyone in this space: equipment values and the dynamics of the secondary market. How would you describe the current state of the used truck market, especially around inventory flow?
Just where the state of the industry is at with all the repossessions happening. A lot of companies are filing for bankruptcy. Every day I get some headline that says bankruptcies are up year over year. these 3 companies filed bankruptcy, and we're getting notices too with it happening with some of our customers. Through all that happening, obviously it's flooding the market with a lot of used equipment. Maybe not at as fast of a pace as it had been the last maybe a year ago, but it's still happening at a pretty rampant rate. And by that all coming on the market, it's obviously dropping the values of used equipment. And with COVID, with the values being so inflated, obviously it's creating a huge gap between where finance companies were financing the equipment and now where the valuations are when they end up having to take it back. So it's really impacted the loss given default on a lot of deals. So that's something we look at very closely. Every deal we have every customer that we have in the portfolio that's of a larger size, say 500,000 or more, our inventory manager will do a portfolio evaluation of what we already have on the books to see what kind of equity we have or what our equity position is in the portfolio. And we've seen drastic declines in that over the last couple of years, just with everything that's been going on.
Sure. And as repossessions have risen, what should lenders be doing to stay ahead of potential exposure?
Yeah, just speaking to us in general, I mean, it's staying consistent with our credit bucket that we want to be in, and asking those additional questions. You can't see everything from just a PayNet report and a credit bureau report. So if there's anything within the deal that you're feeling uncomfortable about, or just knowing where the industry is at, getting that additional information can go a long ways to make sure that you're protecting yourself.
Gotcha. Let's talk about some of your brokers that you guys do business with. How do you identify who some of your top performers are at Wallwork?
Yeah, so we keep statistics on, I guess, the book deals that we do with all the brokers that we work with. If they're not hitting the marks, we just cut ties and say, this isn't a good fit for either of us. And a lot of it starts with the beginning vetting process that we do. So we essentially underwrite the broker and look at the types of deals that they bring in. We make it very clear what our credit parameters are that we want within a deal. So it's all about having those discussions and setting those expectations up front to make sure that it's for both sides. And there's a lot that we have to turn down just because it's not the space that we want to be in. And we have a lot of really good brokers that we do business with, that we've been doing business with for years. It's just something we navigate and watch very closely, just because it does add, like I mentioned earlier, kind of an additional layer of risk when you're not working with the customer directly and going through a broker. Mm-hmm. But there's still good deals to be had going through a broker.
And how do you build trust and loyalty with your brokers?
Yeah, so I guess, I don't know if it'd necessarily be the trust and loyalty, but setting the expectations. We have a broker agreement that we have all brokers sign, kind of laying out our expectations in the relationship, and walking through that with them and letting them know, like, we're the ones doing business with the customer. You're not going to dictate what deals we're going to do. We're going to make that decision on our own. And just, again, trying to make it a mutually beneficial relationship for everybody. Yeah.
Okay. Let's talk about some of the current market climate. Delinquencies, defaults are on the rise. What are some of the things that you're doing to mitigate, some of the rising defaults and delinquencies that clients are seeing in the industry right now?
Yeah, and part of it's just our approach to the collection process. Obviously, on the credit side, we're focusing on the stronger credits, but again, we are taking risk in these deals, and it can get to that stage. Not every deal makes it all the way through. So when it comes to the collection side of it, we do take a very proactive approach to that. We're not waiting until a customer is at the 20 to 30 day past due mark. As soon as they miss a grace period, they're getting a phone call from us. And it could just be something as simple, well, we forgot to make the payment, and we get it resolved immediately. Another thing we watch closely is NSF activity. If we do get an NSF return payment, we're calling the customer right away to figure out what's going on. And again, it could just be an admin issue where they forgot to transfer funds into an account that they make the payments out of, or it could be a bigger issue that we need to get ahead of and try to navigate through. So I think a lot of our success when it comes to the delinquency in this current environment ties into that. when you look at our aging today, I would say over the last 2 years, roughly, it's stayed pretty consistent for us. We've had some upticks throughout that time. It seems like anytime we get something resolved, another one will pop on there. So it kind of maintains the delinquency rate that we have. We have seen some signs of improvement, and we've been able to get some customers off that list and back on track. But yeah, it's tough out there. It's a lot of the conversations we have with these people. They say that this is the worst they've seen it in the history of them being in the industry. And nobody really knows when this is going to turn. If you would have asked us last year, even our customers last year at this time, they would have said, well, mid 2025, it's going to be a lot better. And here we are today, and we're kind of in the same spot. So right now, everybody's saying mid 2026 is when it's going to be. But I don't think anybody really knows. There's a lot going on in the current economy and a lot of changes that are happening. So we're just riding it out and doing what we can do to manage the portfolio properly.
Yeah, and if you don't mind, we can let's pivot and talk about how the current state of affairs, what's going on as far as tariffs, interest rates. How has that impacted your guys' ability to grow?
Yeah, the tariff thing is really interesting because it's hard to understand exactly where those rates are at this point. I know we've put tariffs on different countries, but it seems like it's changing every day. We have actually seen tariff charges showing up on invoices. When we get those deals, I mean, there's no value add to that when you look at a collateral standpoint. So a lot of times we're not going to finance the tariff charge. It's the customer needs to come up with that if they're willing to make that purchase. And we've even talked to some dealerships, and they're kind of taking a proactive approach, knowing that there's going to be something in place. But it's kind of hit and miss on where we see it. It's not consistent right now, but it makes it more challenging to work through a deal if you see that charge on there, and the customer, I guess, doesn't really have any other choice but to pay it.
Are you seeing has there been any type of inventory issue with respect to some of the tariffs from the dealer side?
And transportation equipment, we haven't seen anything. Obviously, if you get into some of the foreign-made vehicles and stuff like that, that's become a challenge for some, but we're not really in that market. So we haven't seen an impact on the inventory piece of it. There was a short period of time where used values spiked a little bit because all the tariffs were coming out, and I guess people were more apt to go buy used equipment than new equipment. But that's kind of subsided now. Yeah.
So, Justin, finally, how do you see the relationship evolving at Wallwork between your asset managers and firms like ACS and the broader ecosystem?
Yeah, and we're a small company, so we don't have all those resources at hand. So we do leverage a lot of those relationships, whether it's with ACS. On the repo side, we have our inventory manager works with a huge network of dealerships and auction companies to market equipment when it gets to that point. I have a big network of attorneys that I work with on the legal side. So having those third-party relationships is huge for us. I understand with a bigger financial institution, a lot of that stuff is handled in-house. But for a company like us, it's a huge value add to what we do.
Great. Thank you. Do you have any questions for me?
Yeah, I'd be curious. Obviously, you guys work with a lot of different lenders and a lot of different industries, and just looking at the transportation market in particular, what are you seeing on the repo side with placements and activity?
We've seen an uptick over the last, I'd say, 45 days. Prior to that, things kind of, I would say, leveled off. But year over year, we have definitely seen a rise in recovery requests. We've been able to mitigate some of that by in getting involved a little further upstream with a lot of clients with some pre-repossession collections, which has helped clients that have just haven't had the manpower or the staff to make those calls on those earlier stage defaults. So we have a great team here that can step in, complement that existing team. we can make those calls, make those outreach efforts more frequently than some of our clients are able to. And then their teams are able to focus more on some of those earlier stage defaults. And over time, you'll see less and less accounts roll over to us either as a pre-recovery collection account or go straight to a repossession. But yeah, we've seen an uptick. We've seen, obviously, over-the-road trucks and trailers. We're starting to see some more vocational trucks. But we also, do a lot of work with clients that finance construction, agricultural, material handling. We've seen some moderate increases, but not at the rates of, what we've seen transportation over the last, 3 or 4 years.
Yeah, just looking at some of the challenges with finding transportation equipment. Obviously, it's all over the country. We know where the customer's home base is, but being able to track down the equipment obviously creates its challenges. And once they hit the stage of repossession, even the collection side, usually communication is lacking. How do you guys approach tracking down this equipment?
No, that's a great question, Justin. I would say, it really starts before that. I mean, the sooner you recognize that a customer is struggling or they're not communicating, the better off your chances are at finding the asset. So it really, really will. You got to make that decision of when you want to go after that asset. So I would say it starts early. Make the decision sooner. That increases your chances of a successful recovery. You're going to get the asset back when it's probably still running versus, when oftentimes we find a lot of assets are broken down, they've been impounded, and then that just compounds, the problem and, increases the cost of the recovery. But if it doesn't have a tracking device on it, at the end of the day, as a service provider, we're really relying on on the skills of the people that we hire here who are professionals who've been, doing skip tracing and collections for, 10 plus years. And they're working with our resources in the field to track down and locate the asset. But without a tracking device, again, it's one of those things where you have to just be patient. And it's very hard to recover something that's moving. So you got to be patient. You have to have the right connections, in that community or in that area, and you got to have people, running addresses and checking popular parking spots where you may find trucks hidden or stored. Again, you got to just have people that are willing to roll up their sleeves and make phone calls and check with people in the industry that are repair shops, dealerships, places where brokers. A lot of things are digital now. I mean, people don't talk on the phone anymore. They don't answer their calls. Text messages. It's even harder getting people to reply to text messages. So it's really relying on your resources in the field to be your eyes and ears. While back here in our command center, we're doing all the directing and asking our agents in the field to go to certain addresses to check on things, or if we have a tip that they may be back in the weekend, we want to make sure that our agents are checking those areas if and when they do return. So, but again, I think to go back to my original point. If you act sooner and, the sooner you decide to make that decision to put it out for repo, you have a higher chance of getting it back in working condition. So that's really where it starts. The longer, the client waits to sign it out for recovery, the harder the effort is. And, we've got 25 plus years of data, various different, portfolios and asset types, and does it have GPS? Does it not have GPS? Transportation versus construction or ag, and we track all that data, and we know how quickly it takes to recover things without GPS. Clients that may assign out at 6 months past due versus somebody that assigns out at 30 days past due. We look at is it an A client as far as their customer profile? Are they A credit customer, B credit, C? These are questions that we ask a client when we're doing business with them, because it gives us an idea how well we may perform for them on their portfolio, and we could even improve on that performance just by making a slight adjustment. And when they assign something out, if they want to improve, help us improve our recovery rates, just by changing or shifting a little sooner could make a big difference. And by the time we find something, we could avoid that unit that breaks down somewhere that's being towed.
Yep. Yeah, and just tying that into kind of our approach with the placement and everything. So obviously on the collection side, we're calling customers as soon as we see any problems arising. If it hits the point where we're not comfortable, and we don't wait a long time. I mean, usually by 30 to 60 days, they're already in payment default prior to that. If we don't have a concrete plan in place and they can stick to the commitments that they're making to us, I mean, we're going to move on trying to find that equipment as soon as possible. Just knowing, like you said, what can happen. Obviously, if they're not paying us, they're running out of cash. They quit taking care of the equipment. So it becomes just a bigger risk for us to take the longer we wait.
Sure. Time is of the essence, right? So but it's tough. You right now, you don't want the equipment back, obviously, but if they've left you no choice and they've stopped communicating, you have to protect your investment and your interest in the asset, and you got to get it back. I mean, you're taking 100% loss if you do nothing and they don't pay. So what if we're able to recover it? Obviously, getting it sooner is going to improve the money you may get when you liquidate. But if we can minimize your loss, that's a win. So that's really, what we're trying to do is we're trying to minimize the loss by getting it as quickly as we can. And, like I said, time's of the essence. So the sooner, you make that decision, the better your chances are.
Yep, absolutely.
Any other questions?
No, nothing else from me.
Okay. Well, that's a wrap for today, Justin. I really appreciate you taking the time to hang out, share your insight. These are the kind of conversations that don't happen enough in our industry. And it's always great to get real about what's working and what's changing. For our listeners, thanks for tuning in to ACS Portfolio Perspective. If you got value out of today's episode, hit that subscribe button and keep an ear out for more unfiltered conversations from the front lines of asset-based lending and equipment finance. Until next time, take care.